Open message to Cathy Wood. Please keep your emotions to yourself. You are going too far by threatening the market with your trades, going long this, going short there. I think what Cathy Wood is saying is she's angry. She is, in my view, showing weakness as a fund manager because she's letting the pain trade get to her. I want to talk about this. The pain trade, I want to explain what it is. It is basically the things that you're long are going down, the things that you're short or at least mentally short are going up, and you're getting angry at that. This is a very, very common occurrence with fund managers, particularly fund managers that have views on both sides of the trade, what should be up, what should be down. I feel like the market is certainly way too big to go after Cathy Wood. I think she's more a canary in the coal mine. She's showing her frustration, is showing what the underlying currents are in the market. I want to talk about that. And I also want to explain our massive drawdown we had today, 7.7%. We are now down almost, we're 40% below our peak for this year. So we really had a massive drawdown within 6 weeks. And this just comes to show that when we say we embrace volatility, volatility is the business, then that's really what we mean. This is not just some theoretical thing. And whoever is in the wealth generating business has to understand that this is an occurrence. It happens all the time. And the way to manage this is, one, emotionally, and second, of course, make sure the leverage is in line with what you can stomach. This is a Not Even Wrong podcast. It's December 16th, 2021. This is Crim Delco for the day where the fund is down 7.7%. The market is flat. For the year, we are now up 18.3%. The market is up 23.3%. We're underperforming by 5%. This is the first time we're underperforming in months. We have been outperforming consistently, and unfortunately now the sign is back to underperformance. Now, having said that, of course, we are clear that this is happening because of a trade that is going on, and this is exactly what I want to talk about here. So let's just jump right into it. So yes, we lost money on Tesla, we lost money on the biotech index, we're losing money on the Bitcoin. We're basically losing money on pretty much everything that we own, and this is in context of a situation where other things are not losing money. So this is not a overall everything is down type of market situation. This is simply us being on the wrong side of the trade. And I think let's talk about Cathy Wood and what we think is going on. Cathy Wood is the canary in the coal mine. What does that mean? We believe that she is not the reason why things are happening, but her frustration, her trade that she has on is going wrong, and she is being frustrated because of that, and the underlying currents in the market are going against her. So Cathy Wood is long disruption. She is probably not physically short, but mentally short anything which is being disrupted. So she's long Tesla, short Ford, she's long Shopify, short Walmart, she's long Bitcoin, short Goldman Sachs, etc. So she thinks that not just that the things that she's long should be money makers because they're going to be disrupting things. She also thinks that the disrupted entities should be short. And that trade is going terribly wrong this year. Like we said, we are underperforming the S&P, and I think we are actually doing much better than her funds because we have different allocations. Philosophically, we're on the same page like Cathy Wood, but practically we just have different positions. We have a much bigger position in Tesla, for example, and we don't have positions in stocks that she owns. It's just Shopify, Square, or things like that. So let's get back to the point. What do I mean with currents in the market? What do I mean with frustration? So the currents in the market are, there are big capital flows driven by either portfolio managers or algorithms. Doesn't really matter, but big capital flows are going in two directions. One is they're going into companies that have low valuations. So the valuation trade is on, as they might say on Wall Street. So what we were talking about just weeks ago, that the old valuation metrics don't seem to work anymore. And they are working right now in the short term. They are working. If you buy things that are cheap and short things that are expensive, you make money. Now, what do I mean with expensive? Just to keep it simple, if you use the old-fashioned value investment model, you basically buy whatever looks interesting on a value investment thesis, and you short whatever doesn't look interesting. So you would buy Ford again, which looks relatively cheap based on earnings, price to book, things like that, and you would short Tesla, which looks expensive. So this is what we said a few weeks ago doesn't work because of what we called exponential growth. Now, just to be clear, if you did this trade over the last 5 years, you would have lost a fortune. So this is, of course, a short-term occurrence, and we're very clear about that. We're very clear about the fact that it is a short-term occurrence, and we are absolutely not changing our mind about this stuff or anything like that. This is not, but having said that, it is still worth to be noted that this is happening. And why this is happening is one of the story, and what does it actually mean for people like us or Cathy Wood is the other. So why is it happening? There is, like always in situations like that, probably many reasons why this could be happening. The most obvious reason is that we have the Fed starting to tighten rates, raise rates, slow down the economy, and a short-term impact of that is that discount rates will go up. If discount rates go up, then future cash flows are worth less. Future cash flows worth less means high growth stocks, exponential kind of growth stocks, they lose in value. In other words, relative valuations come back in line, which is that the extreme discrepancy between, let's say, a market cap of Ford, which is 80 billion, and a market cap of Tesla, which is 1.2 trillion, that those two need to kind of converge a little bit more. Same happens, let's say, if we look at something like Square and Goldman Sachs, if we look at something like Walmart and Shopify, it's all in the same reel. Now, why is this happening? Again, the Fed is tightening. I think it's in line with what came out yesterday. Jerome Powell spoke about an accelerated tapering and a potential faster increase of interest rates. So the high growth stocks are being punished. Now, this, of course, is it's like one of those things where it kind of sounds logical, but then you can immediately ask the question, so why now? This has been known for weeks, months. Why now? Well, first and foremost, yes, it has been known for weeks. And like I said, in the last 6 weeks, we have corrected by about 40% in our fund. So this trade has been going on for a while. This is not just now this particular situation with the Fed from yesterday. This has been going on for a while, has been anticipated by the market. So number one. Number two, that we believe that when these types of currents start changing, so whenever let's say this buying this and selling that starts kicking in, then things like momentum funds start kicking in, and leverage starts kicking in, and a lot of things start happening. Leverage, I mean both ways. So people are putting on leverage to put on the trade, but also people who have leverage and are long, let's say Tesla or Shopify and etc., they have to reduce their leverage. So there is a sort of a first, second, third, fourth derivative type effect on all these stocks, and therefore it takes a bit longer for this to work itself out. The question now is, when does it stop? It usually stops when valuations get in some sort of relationship where, let's say, this buyers start coming back into the other side of the trade, so start buying the growth stocks and selling the value stocks, or when the algorithms start doing that. Again, it's hard to distinguish between those two things, but in general, these types of stuff stops when valuations get in line, when the fundamentals catch up with the situation. Now, why do we think Cathy Wood should be careful about her emotions? Well, she went out a few days ago saying that she believes that all the growth stuff will do even much better, and all the value stuff, so the companies that are being disrupted, will suffer even more. So she said she'll double down, she'll even short those, or in other words, short part of the S&P which is not growth, and buy even more growth. I think that was a little bit of a knee-jerk reaction, emotional reaction, because she is suffering in her funds. If you look at her genomics fund, for example, down 36% for the year. If you look at her innovation fund, down about 20% for the year. So those are bad numbers for a portfolio manager in an up market. It is not pretty. It is not pretty. And yes, you have a good performance since inception, but we know, we all have been there. This is the purpose of this podcast, is give people a sense for what it feels like to run a hedge fund. So let me tell you, your customers will not be happy. You will be feeling uncomfortable as a portfolio manager, even if you don't have investors, because you're losing money in a year when everything else is up. This is the most difficult thing a portfolio manager can go through. If you're in the wealth generation business, these things will happen. There will be reversals, because by definition you have a different trade on than everybody else. That's why you're generating wealth, and you will have these reversals. And yes, last year we were up 5x in the fund. This year we're up 18% when the market's up 23. So clearly we will always take that relationship. If I had to sign 2 years ago that you will be up 5x in 1 year and then underperform by 5% in the second year, still be up, I would have taken that. But no, nevertheless, it just feels bad. And again, what it feels like to run a hedge fund, emphasis on feels like. I can't give anybody any kind of theoretical reasoning, logic, any of that stuff of how to run a hedge fund. This is not my place. My place is to try to convey my feelings, my emotions, which is a lot what this business is about. This business consists of feelings and emotions, of knee-jerk reactions here, knee-jerk reactions there, and mostly trying to avoid those types of knee-jerk reactions. Why? Because you could be tempted to do stupid things. You could be tempted to, let's say, turn the back to your principal stack. Turn back to your principal stack, very, very dangerous. Turn the back to whatever strategy you're pursuing. There are times when one should do that. I'm not saying you should always be stubbornly pursuing your principal stack, but don't do it just because the market is telling you right now it's not working. The market is telling us right now it's not working, and I think the most important question we should ask ourselves is, okay, why are these currents happening? I just explained, there's the Fed, there's the tightening. So what is the midterm effect of this? And the midterm effect of this is, I believe that it's a good thing. We believe it's a good thing that rates are going up, that money is getting tighter. It will wash out leverage out of the system. It will get better companies even in better positions. It will slower the threat of inflation. Inflation is bad for everybody, but in particular bad for poor people. And inflation is bad for everybody, and it kind of levels the playing field. Inflation makes it, let's say, if we take just a very simple example, we have a competition between Tesla, Ford, and GM. Inflation makes it easier for Ford and GM to sustain the competitive pressure that Tesla is putting on them, because everybody can raise prices. Everybody can, through the possibility of raising prices, you can also kind of disguise your cost structure, and therefore you have, in my view, a better chance to survive. In a higher rates environment, when money gets more expensive, mistakes show faster, and companies that have margin pressure or cost structure problems, etc., they will come under pressure much faster. In other words, we believe that in the mid to long term, Cathy Wood is right. The disruptors will even win faster if rates go up, because the economy will get more into a sort of meritocracy mode, and the winners will win. So the Shopifys, the Teslas, the Nvidias, they will keep winning in the marketplace, versus companies that are being disrupted will be on the losing side of this equation. So to circle back now to the beginning, when I said, please, Cathy Wood, keep your emotions to yourself, this is an open message to Cathy Wood. You're a great marketer. You're incredibly good at explaining your ideas, inspirational. You're a portfolio manager. You're not a wealth generator per se. You're a portfolio manager. And because you're a portfolio manager, I think you should try to keep your emotions to yourself. There are periods of time when trades don't work. They're usually isolated periods of time. They're not extremely relevant unless you have too much leverage. If not, you'd find you will get through this. You will get through this, and you will come out even stronger on the other side. For now, what it means is keep your head down. If you want to short something, short it, but not because you're angry or because you have a conviction that theoretically something should be short. I think a short is only good if you have some sort of sense for timing. Otherwise, it's just a risk reward. It's not good enough. If you have a sense for timing, then that's a good idea to short things. At Orange Capital Partners, we don't. typically we have been pretty bad with our shorts in the last 13 years since inception. So we're not really going out there talking too much about it. I just believe that shorting something is a little bit like putting on an options trade. You just simply have to have a sense for timing. If you don't have that, just stay away. Stay with what you're good at. In our case, it is understanding disruption, understanding fundamentally new concepts and engineering practices with large impact, understanding the concept of iteration, the cost of iteration, and the rapid innovation, which is the actual competitive advantage that companies get in the marketplace. Those are the kinds of things we focus on. We're still very comfortable with Tesla. We're comfortable with the CRISPR stocks, and of course, our Bitcoin position is, in a sense, also being validated because as we spoke yesterday, the centralization of finance through the Fed is creeping further, and therefore, hopefully, will be replaced soon by a rule-based monetary system, which is Bitcoin. Thank you.